John A.G. here. In 2008, the signs were there 6 months early, but only for those watching the right data. The collapse files exists because history repeats for those who don't study it. Today, I'm showing you something that will happen in 2026, and the countdown has already begun. This isn't theory, this is scheduled. Let's decode it together. In 1982, the global debt crisis began not with a massive default, but with Mexico announcing it could not make an $80 million interest payment on its $80 billion debt, a payment representing just 0.1% of the total. Within 18 months, 16 nations had defaulted or restructured. The problem was not the size of the missed payment. The problem was that admitting inability to pay one installment revealed the entire debt structure was unsustainable at any realistic interest rate. Once that truth became undeniable, the cascade was inevitable. Today, in 2026, approximately $9.1 trillion in government and corporate debt across developed economies matures and must be refinanced within a single 12-month period. This represents the largest annual debt rollover in global financial history. The debt was issued primarily during 2021 when central banks suppressed interest rates to near zero. Governments borrowed at 0.5 to 2%, corporations at 2 to 4%. Now these borrowers must refinance at rates of 4 to 7%, effectively doubling or tripling their interest expense with no corresponding increase in revenues or economic capacity to service higher costs. When the largest concentration of maturing debt in history coincides with interest rates, triple those at issuance, and when this convergence spans sovereign governments, multinational corporations, and commercial real estate simultaneously across all major economies. What does history reveal about whether such massive rollovers occur smoothly through refinancing or catastrophically through recognition that the debt was never sustainable at market rates? For most of human history, the concept of simultaneous mass debt maturity across nations and sectors did not exist because the mechanisms that create such concentration, synchronized global monetary policy, integrated international capital markets, coordinated fiscal stimulus, did not exist. Economic crises were typically sequential rather than simultaneous, with problems in one sector or region spreading gradually to others over years rather than cascading within months. In ancient Rome, debt was primarily private, existing between individuals, merchants, or between citizens and moneylenders. Government debt existed but was modest and typically owed to specific creditors who had financed military campaigns or public works. And when borrowers could not repay, the consequences were individual rather than systemic. Debtors faced slavery, asset seizure, or for governments, the disgrace of broken promises to powerful families. But these failures did not cascade through the entire economy, because most commerce operated through barter or commodity money that required no counterparty trust. A farmer could sell grain for silver coins and use those coins to purchase tools without depending on any credit relationship or trusting any intermediary's promises. Medieval European monarchs borrowed from banking houses to finance wars and imperial ambitions. The Medici in Florence, the Fuggers in Augsburg, the Bardi and Peruzzi across Italy, these banking families lent to kings by taking personal risk with their own accumulated wealth. The loans had specific maturity dates when principal was due, often tied to expected tax revenues or treasure shipments. Defaults were common and expected. The Spanish crown defaulted 6 times between 1557 and 1647, despite controlling the richest silver mines in the New World, but each default was isolated and contained. The Spanish king's inability to repay Italian bankers did not immediately affect English wool merchants or German craftsmen because economic activity was largely regional and non-credit based. The critical constraint that prevented cascading failures was that a lender who suffered losses could not continue lending at previous scale. When Edward III of England defaulted on massive loans from the Bardi and Peruzzi banks in the 1340s, bankrupting both institutions, it reduced credit available to other borrowers, but did not create systemic collapse across Europe. Trade continued using gold and silver coin. Agricultural production continued. Manufacturing continued. The economy functioned, albeit with less leverage and slower growth. The damage was severe for the creditors, but localized rather than systemic. The 19th century saw the emergence of government bond markets, where sovereigns issued tradable debt with fixed maturity dates that could be bought and sold by anyone with capital, not just banking syndicates. This democratization of lending allowed broader participation. Middle-class citizens could buy government bonds. Retired military officers could invest pensions in railroad bonds. Widows could hold municipal bonds for income. But borrowers recognized the danger of maturity concentration and actively avoided it. Maturity schedules were carefully staggered across decades. A railroad company issuing bonds in 1870 might have maturities in 1875, 1880, 1885, and 1890, spreading obligations over time so that refinancing risk was distributed and manageable. If economic conditions made refinancing one maturity difficult, the company might default on that series while continuing to service bonds maturing in other years. The damage would be contained to a subset of creditors, rather than destroying the entire enterprise. This principle, that concentrated maturity is dangerous and must be avoided, was widely understood and deliberately engineered away by prudent borrowers. The lesson had been learned through painful experience when too much debt comes due simultaneously during a period of credit market stress. The result is not orderly refinancing, but forced liquidation, bankruptcy, and cascading failures through interconnected credit markets. The Great Depression demonstrated catastrophically what happens when this principle is violated at scale. During the prosperity of the 1920s, corporations and municipalities issued massive amounts of debt expecting to refinance at maturity as a matter of routine. Corporate debt doubled from $26 billion in 1920 to $89 billion by 1929. The issuance was heavily concentrated in the late 1920s, creating substantial maturity concentrations in the early 1930s. Borrowers assumed credit would always be available at reasonable rates because that had been their experience during the boom. When credit markets froze in 1930, maturing debt could not be refinanced. Borrowers who had issued bonds expecting routine rollover suddenly faced a binary choice: pay in full from operating cash flow, which was impossible for most given the leverage ratios they had accumulated, or default. The result was a cascading wave of defaults. Corporate bond default rates reached 16% in 1933, meaning 1 in 6 corporate bonds failed. Municipal defaults exceeded 4,000 across the United States. Over 9,000 banks failed between 1930 and 1933, many because they held defaulted corporate or municipal bonds in their portfolios. The cascade occurred through interconnected credit markets. Bank failures reduced lending capacity across all sectors. Reduced lending forced more borrowers into default, as maturing obligations could not be refinanced. More defaults caused more bank failures. The spiral fed on itself because credit markets were integrated. A problem in corporate bonds affected banks, which affected municipal bonds, which affected more banks. The maturity concentration that had seemed manageable during prosperity became catastrophic once credit conditions tightened. Within 3 years, the financial system had essentially collapsed, requiring government intervention on an unprecedented scale to prevent complete economic breakdown. The lesson was clear and would be understood by generations of bankers and policymakers. Concentrated debt maturity is a systemic vulnerability that transforms individual refinancing risk into collective crisis, when credit markets cannot absorb the supply of obligations coming due simultaneously. The solution was to stagger maturities, maintain conservative leverage, and never assume credit would be perpetually available at stable rates. For decades following the Depression, borrowers and regulators respected this principle. Then, slowly, as the crisis faded from living memory, the constraints began to erode. The modern phenomenon of synchronized global debt maturity emerged from structural changes in how monetary policy, fiscal policy, and credit markets operate across developed economies. What began as emergency responses to the 2008 financial crisis became normalized policy for over a decade, fundamentally altering how governments and corporations approached borrowing and debt management. The changes were gradual at first, then accelerated dramatically during the COVID pandemic, creating the conditions for the unprecedented maturity concentration approaching in 2026. Following the 2008 crisis, central banks across developed economies cut interest rates to zero or negative and maintained them there for over a decade. The Federal Reserve held rates at 0 to 0.25% from December 2008 until December 2015, then returned to near zero in March 2020. The European Central Bank pushed rates into negative territory in June 2014, where they remained for 8 years. The Bank of Japan has operated at zero or negative rates since the late 1990s, with brief interruptions. This coordinated ultra-low rate environment was unprecedented in both scale and duration across all major currency zones simultaneously. The effect was to make borrowing extraordinarily cheap globally. A government could issue 10-year bonds at yields of 0.5%. Investment-grade corporations could borrow at 2 to 3%. Even high-yield companies rated below investment grade could access capital at 4 to 5%, rates that historically would have been reserved for the highest quality borrowers. These rates were not market-determined based on credit risk assessment and supply-demand equilibrium. They were policy-determined, artificially suppressed by central banks purchasing trillions in bonds to hold yields down regardless of what private market participants would have demanded. The mechanism was quantitative easing, central banks creating money electronically and using it to purchase government bonds, mortgage-backed securities, and in some cases, corporate bonds from the market. The purchases created artificial demand that pushed bond prices higher and yields lower than any private market clearing level. From 2008 through 2019, global debt expanded at rates far exceeding economic growth. Government debt across developed economies grew from approximately $35 trillion to $52 trillion, a 50% increase while GDP grew only 25%. Corporate debt grew from $8 trillion to $13 trillion. Total non-financial debt reached over $70 trillion globally. The growth was enabled entirely by central bank policy, creating artificial demand for debt that suppressed yields and made even marginal borrowers appear creditworthy. Private markets would not have funded this expansion at these low rates without the central bank bid providing price support and liquidity guarantees. The COVID pandemic triggered the most extreme version of policies that had been building for over a decade. In March 2020, as governments imposed lockdowns and economic activity collapsed, credit markets froze. Corporate bond markets seized up as investors refused to buy new issuance at any price. Government bond markets experienced dysfunction as even treasury markets, supposedly the deepest and most liquid in the world, saw bid-ask spreads blow out and dealers unable to make markets. The freeze was driven by uncertainty about the pandemic's duration and economic impact, creating a flight to cash that made credit unavailable regardless of the borrower's quality. Central banks responded with overwhelming force and coordination not seen since World War II. The Federal Reserve cut rates to zero, announced unlimited quantitative easing with no preset limit on purchases, and created a dozen emergency lending facilities targeting every segment of credit markets. Within 3 months, the Fed's balance sheet expanded from $4 trillion to $7 trillion, eventually reaching $9 trillion by 2022. The expansion of $5 trillion in 2 years exceeded the entire accumulated expansion of the previous decade. The European Central Bank expanded from $4.7 trillion to $8.8 trillion. The Bank of Japan from Y550 trillion to Y740 trillion. Bank of England from 500 billion to 900 billion. Combined, the four major central banks expanded balance sheets by over 10 trillion in 18 months, creating money at a pace never before seen in peacetime. Simultaneously, governments enacted fiscal stimulus that dwarfed any prior peacetime spending. The United States borrowed and spent over $4.5 trillion in 2020 and 2021 through multiple programs. Direct payments to households expanded unemployment benefits, business loans and grants, state and local government support. The European Union enacted $1.8 trillion in pandemic recovery programs. Japan implemented stimulus exceeding Y100 trillion. Across developed economies, governments borrowed and spent over $8 trillion in 2 years, roughly 10% of combined GDP. Nearly all of this was financed at near zero interest rates because central banks were buying most new issuance directly or providing liquidity that allowed markets to absorb the supply. Corporate borrowing followed similar explosive patterns. U.S. corporations issued $2.3 trillion in bonds during 2020 and 2021, with investment-grade companies borrowing at 2 to 3% and even high-yield issuers accessing capital at 4 to 5%, despite many facing severe business disruption. European corporate issuance exceeded $500 billion during the same period. Asian corporate issuance surpassed $600 billion. The global corporate borrowing surge was enabled by Federal Reserve programs that purchased corporate bonds directly, including high-yield debt, sending an unambiguous signal that credit would not be allowed to contract and that even weak borrowers would have access to capital. The critical characteristic of this issuance wave was that most debt was issued with 5-year maturities. For governments, 5-year notes were the most popular maturity because they offered modestly higher yields than 2-year notes, while remaining easily marketable to a broad investor base. For corporations, 5-year bonds were the standard maturity, representing a balance between borrower preference for longer terms that delayed refinancing and investor preference for shorter duration that limited interest rate risk. For commercial real estate, 5-year loans were typical for permanent financing after construction. The 5-year maturity became standard across all borrower types, not through coordination, but through each party, making individually rational decisions, given market conditions and investor preferences. This created mathematical certainty. Debt issued in 2020 and 2021 with 5-year maturities would mature in 2025 and 2026. The concentration was not intentional or coordinated, but emerged mechanically from all borrowers, responding to the same incentives created by synchronized global monetary policy. No individual borrower was behaving imprudently given the environment. Governments were responding to pandemic emergency. Corporations were securing liquidity to survive uncertainty. Real estate borrowers were refinancing at dramatically lower rates. But the aggregate effect was to create the largest maturity concentration in financial history, with roughly $9 trillion in obligations scheduled to come due in a narrow 12 to 18-month window. The assumptions underlying all this issuance were explicit and universal across borrowers. First, interest rates would remain low indefinitely because inflation was structurally dead. Central banks had struggled for over a decade to reach even 2% inflation targets, and there was no reason to expect change. Second, central banks would continue quantitative easing or at minimum maintain enlarged balance sheets, providing permanent support to bond markets. Third, economic growth would gradually recover from the pandemic, improving corporate revenues and government tax receipts, making debt service easier over time. Fourth, refinancing at maturity would be routine at similar or even lower rates, given the low inflation, low rate environment was expected to persist indefinitely. By 2022, every single assumption had proven catastrophically wrong. Inflation surged not to 2%, but to 8 or 9% across developed economies, the highest rates in 40 years. The causes were multiple: supply chain disruptions from pandemic lockdowns and reopening, massive fiscal stimulus increasing demand, energy price spikes following Russia's invasion of Ukraine, and labor market tightness creating wage pressures. But the effect was undeniable. The low inflation regime that had justified low rates and quantitative easing had ended abruptly. Central banks were forced to reverse course with speed and severity not seen since the 1980s. The Federal Reserve raised rates from 0 to 5.25% in just 18 months, the fastest tightening cycle in 40 years. The European Central Bank raised from negative 0.5% to 4%. Bank of England raised to 5.25%. Even the Bank of Japan, which had maintained negative rates for decades, ended its negative rate policy. The rate increases were synchronized globally because inflation was a global phenomenon requiring coordinated policy response. Simultaneously, central banks began quantitative tightening, allowing bonds to mature without replacement, actively shrinking balance sheets. The Federal Reserve announced it would reduce holdings by up to $95 billion monthly, allowing the balance sheet to decline from $9 trillion toward $7 trillion. The European Central Bank began reducing holdings from $8.8 trillion. The dominant buyers of government debt for over a decade were not just stepping back, they were becoming net sellers, adding supply to markets already facing record new issuance from ongoing government deficits. This created the 2026 maturity wall through simple arithmetic. Approximately $9.1 trillion in debt had been issued during 2020 and 2021 at interest rates of 0.5 to 4% with 5-year maturities. That debt would mature in 2025 and 2026. The breakdown across sectors and geographies reflected where the borrowing had been most aggressive. U.S. government debt of $2.9 trillion. European government debt of $2.1 trillion. Japanese government debt of $1.4 trillion. U.S. corporate bonds of $1.2 trillion. European corporate bonds of $0.7 trillion, Asian corporate bonds of $0.5 trillion, and global commercial real estate loans of approximately $0.3 trillion. All of this must be refinanced or repaid within 12 months. Repayment from cash flow is impossible. Governments run structural deficits. Corporations use borrowed proceeds for share buybacks and operations, not cash reserve accumulation. Real estate investments rely entirely on refinancing. Therefore, essentially, all $9.1 trillion must be refinanced. But the refinancing will occur at rates double or triple the original issuance. Government debt issued at 1% must refinance at 4 to 5%. Corporate debt issued at 3% must refinance at 6 to 9%, depending on credit quality. Commercial real estate loans issued at 3 to 4% must refinance at 7 to 8%, if refinancing is available at all given property value declines. The refinancing will occur in credit markets that no longer have central bank support providing artificial demand. The Federal Reserve, ECB, and Bank of Japan that purchased trillions during 2020-2021 are now reducing holdings, creating net supply rather than demand. Foreign central banks that historically absorbed substantial portions of government debt issuance have reduced their reserve accumulation, with dollar reserves declining from 58% of global reserves to 56%. The private market participants who must absorb this wave, pension funds, insurance companies, mutual funds, individual investors, face competition from ongoing government deficit financing that adds another 2 to 3 trillion in new issuance beyond the refinancing needs. The quantitative evidence of the 2026 debt maturity concentration reveals the mathematical impossibility of smooth refinancing at current market rates without either substantial yield increases to attract demand, aggressive central bank intervention to suppress yields, or widespread defaults when refinancing proves unavailable. United States government debt maturing in 2026 totals approximately $2.9 trillion in Treasury notes and bonds. The average coupon rate on this debt at issuance during 2020 and 2021 was 1.2%, reflecting the ultra-low rate environment maintained by Federal Reserve policy and quantitative easing that suppressed yields. Current market rates for refinancing this maturity profile in late 2025 stand at approximately 4.7% for 10-year notes and 4.9% for 30-year bonds. The differential represents an increase of 350 basis points, meaning interest expense will more than triple on this tranche of debt when refinanced. The additional annual interest expense from refinancing this $2.9 trillion at current rates rather than original issuance rates would be approximately $101 billion, a permanent increase that persists every year the debt remains outstanding. This represents a 290% increase in interest cost on this specific maturity cohort. Total U.S. government interest expense in fiscal year 2024 was $880 billion. Adding $101 billion from just this single year's refinancing, combined with ongoing deficit borrowing requiring additional new issuance, could push total annual interest expense above $1.1 trillion by 2027. At that level, interest would consume approximately 22% of federal revenue before any government services, defense spending, or entitlement programs are funded. European government debt maturing in 2026 across European Union member states totals approximately $2.1 trillion in bonds denominated in euros. The average coupon at issuance was extraordinarily low, approximately 0.3%. Because many European sovereigns issued at negative yields during the period when the European Central Bank's negative interest rate policy and aggressive quantitative easing pushed government bond yields below zero. Germany, the Netherlands, and other core European economies routinely issued 10-year bonds at negative 0.2 to negative 0.5% during 2020 and 2021, meaning investors paid governments for the privilege of holding their bonds. Current refinancing rates in late 2025 stand at approximately 3.4% for core European economies and 4.5 to 5.5% for peripheral economies like Italy and Spain. The interest expense increase is even more dramatic than in the United States because the starting point was zero or negative. Germany refinancing bonds issued at negative 0.2% will now pay 3.5%, an infinite percentage increase in absolute cost terms. Across all European sovereign debt maturing in 2026, the additional annual interest expense from refinancing at current rates is approximately $65 billion. For weaker European sovereigns, the refinancing creates severe fiscal stress. Italy, with government debt exceeding 140% of GDP, faces refinancing at 4.8% versus near zero issuance costs. Spain faces similar dynamics. The fiscal sustainability questions that plagued Europe during the 2010 to 2012 sovereign debt crisis are re-emerging as refinancing costs surge. Japanese government debt maturing in 2026 totals approximately $1.4 trillion in Japanese government bonds. The average coupon at issuance was 0.1%, reflecting decades of zero or negative rate policy by the Bank of Japan. Current refinancing rates stand at approximately 1.2%, which appears modest compared to U.S. or European increases. However, this rate is maintained only through Bank of Japan, intervention capping yields through yield curve control policy. The BOJ announces it will not allow 10-year JGB yields to exceed 1% and enforces this cap by purchasing whatever quantity of bonds is necessary to prevent yields rising above the target. This means the refinancing is not occurring through private market demand but through direct BOJ monetization. The additional annual interest expense from refinancing at 1.2% versus 0.1% issuance is approximately $15 billion, which appears manageable. But the mechanism reveals the fragility. The debt is only sustainable because the central bank prints money to buy it. If the BOJ were to allow market-determined yields, rates would likely spike to 2 or 3%, given Japan's 260% debt-to-GDP ratio, making the debt service unsustainable without dramatic fiscal adjustment. United States corporate debt maturing in 2026 totals approximately $1.2 trillion, split between investment-grade issuers at roughly $820 billion and high-yield issuers at roughly $380 billion. Investment-grade corporate bonds were issued during 2020 and 2021 at average coupons of 2.8%, taking advantage of Federal Reserve programs that purchased corporate bonds and suppressed spreads. Current refinancing rates for investment-grade corporate bonds stand at approximately 6.2%. representing a 340 basis point increase. For the $820 billion in maturing investment-grade debt, the additional annual interest expense from refinancing at 6.2% versus 2.8% is approximately $28 billion. For many large, well-capitalized corporations, this increase is manageable, though certainly painful. It represents funds that must be diverted from capital investment, research, dividends, or share buybacks to debt service. High-yield corporate debt tells a more distressed story. These bonds were issued at average coupons of 4.1% during the period when even junk-rated borrowers had easy access to capital. Current refinancing rates for high-yield debt stand at approximately 8.9%. The $380 billion in maturing high-yield debt faces an additional $18 billion in annual interest expense. For many high-yield issuers, this increase is not manageable. Companies that generated barely sufficient cash flow to cover 4% interest cannot cover 9% without dramatic restructuring, asset sales, or default. Credit rating agencies project high-yield default rates rising from current 3.8% to 6.5% to 8% during 2026, as this refinancing stress materializes. European corporate debt maturing in 2026 totals approximately $700 billion, split between roughly $480 billion investment grade and $220 billion high yield. The dynamics mirror the U.S. experience. Investment grade European corporate debt was issued at average coupons of 2.1% and must refinance at approximately 5.8%, creating additional interest expense of roughly $18 billion annually. High-yield European debt issued at 3.6% must refinance at 8.4%, creating additional interest expense of approximately $11 billion. The combined $29 billion in additional European corporate interest expense creates stress patterns similar to the U.S. Investment-grade issuers face manageable but painful increases, while high-yield issuers face potential insolvency. Commercial real estate loans maturing globally in 2026 total approximately $300 billion, concentrated in office and retail properties that have experienced severe value declines. These loans were originated during 2020 and 2021 at interest rates of 3 to 4% against property valuations that reflected pre-pandemic conditions or early pandemic expectations of rapid recovery. Current commercial real estate lending rates stand at 7 to 8%, where financing is available at all. The more severe problem is that property values have declined 35 to 50% for office buildings and 25 to 40% for retail properties. A $70 million loan originated against an office property valued at $100 million in 2021 now faces refinancing against a property worth perhaps $55 million. The property has negative equity. The loan exceeds the property value. Lenders will not refinance such loans without substantial principal paydown to restore viable loan-to-value ratios. Property owners face a choice: inject tens of millions in new equity to pay down loans to levels lenders will refinance, or default and surrender the property. Most choose default, creating a wave of distressed commercial real estate that must be liquidated at deep discounts, establishing new price comparables that force mark-to-market losses across the entire sector. The aggregate additional interest expense from refinancing the $9.1 trillion in maturing debt at current market rates rather than original issuance rates totals approximately $270 billion annually. This includes roughly $181 billion for government debt, roughly $77 billion for corporate debt, and approximately $12 billion for commercial real estate. This $270 billion represents a permanent increase in global debt service costs that must be funded from tax revenues, corporate cash flows, or property incomes that have not increased proportionally. Governments must cut spending elsewhere, raise taxes, or run even larger deficits that require even more borrowing. Corporations must reduce investment, cut dividends, or face downgrades and potentially default. Property owners must accept lower returns or face foreclosure. The credit market capacity to absorb this refinancing requirement reveals the systemic challenge. Global bond issuance across government and corporate sectors averaged approximately $8.5 trillion annually during 2022 through 2024. This includes all maturities, new money borrowing for deficits and expansions, plus refinancing of maturing debt. The 2026 maturity wave of $9.1 trillion must be refinanced, in addition to new deficit borrowing of approximately $2.5 trillion across developed economy governments. Total funding requirement is therefore $11.6 trillion, since markets structured to absorb $8.5 trillion annually must absorb $11.6 trillion, 36% above normal capacity. Even if all discretionary corporate borrowing for mergers, acquisitions, and expansions is deferred, even if all non-essential government borrowing is eliminated, the maturity wall plus unavoidable deficit financing exceeds market capacity substantially. The gap must be filled through some combination of dramatically higher yields to attract additional private capital, renewed central bank quantitative easing to create artificial demand, or defaults reducing the amount requiring refinancing through involuntary debt reduction. The approaching $9.1 trillion debt maturity wave is sending signals through global credit markets, government bond markets, currency markets, and corporate behavior that reveal how sophisticated market participants are pricing the refinancing risk and positioning for the stress they anticipate. Credit spreads have widened substantially and synchronously across all developed markets over the past 18 months. Credit spreads measure the additional yield over equivalent maturity government bonds that corporate borrowers must pay. compensating investors for default risk and liquidity risk. U.S. investment-grade corporate bond spreads have widened from 90 basis points over Treasuries in early 2024 to 145 basis points in late 2025, representing a 61% increase. U.S. high-yield spreads have widened from 320 basis points to 485 basis points over the same period, a 52% increase. European investment-grade spreads have widened from 105 basis points to 165 basis points. European high-yield spreads have moved from 380 basis points to 520 basis points. The widening is not isolated to one market or credit quality tier. It is occurring across all geographies and all ratings categories simultaneously. This synchronized global widening indicates market participants are demanding higher compensation for credit risk in anticipation of elevated default probabilities when the refinancing wave hits and some borrowers prove unable to access capital at affordable rates. The pattern of credit spread widening by maturity is particularly revealing. Bonds maturing in 2026 and 2027 trade at wider spreads than bonds maturing in 2028 and beyond from the same issuers. This creates an inverted credit spread curve that signals markets are pricing specific refinancing event risk in the near term as higher risk than longer-term fundamental credit risk. Investors are effectively saying that even for strong companies, the act of refinancing during the 2026 maturity wall period is itself risky enough to demand additional compensation beyond the normal credit spread. This inversion is unusual and specific. It appears in corporate credits, in some sovereign credits, and in structured products backed by loans. The consistency across markets indicates shared recognition that the maturity concentration itself creates a systemic risk independent of individual borrower quality. Government bond yield curve shapes across major economies have flattened dramatically or inverted, sending recession signals that have historically preceded economic contractions with high reliability. The U.S. Treasury yield curve shows 10-year notes at 4.67% versus 2-year notes at 4.45%, creating a spread of only 22 basis points. This is flatter than 95% of all historical observations, indicating bond markets expect near-term economic weakness will force the Federal Reserve to cut rates sharply, making current long-term yields of 4.67% attractive compared to expected future short-term rates that could fall to 2 to 3% during recession. Germany's yield curve shows 10-year bunds at 2.65% versus 2-year Schatz at 2.81%, an inversion of 16 basis points. UK gilts show a similarly flat curve with 10-year at 4.89% versus 2-year at 4.72%, only 17 basis points of spread. Japan's curve appears steeper at 57 basis points, but only because the Bank of Japan artificially caps 10-year yields at 1% through unlimited purchases, preventing market-determined pricing. The consistent pattern across developed markets is that bond investors are pricing near-term economic and financial stress, requiring central bank easing, consistent with refinancing difficulties, triggering broader economic contraction. Central bank policy responses have diverged despite the shared global maturity challenge, revealing the constraints central banks face that limit their ability to ease preemptively to facilitate refinancing. The Federal Reserve has cut rates modestly from the 5.25% peak to 4.5%, but continues quantitative tightening, allowing bonds to mature without replacement. The ECB has held rates steady at 4% and continues reducing balance sheet holdings, concerned that inflation remains above target and that premature easing would risk re-accelerating price increases. The Bank of Japan has ended its negative rate policy, taking rates from negative 0.1% to 0.25%, but maintains yield curve control capping 10-year yields at 1%. The Bank of England holds rates at 5.25% with no cuts announced. The divergence creates currency volatility and complicates refinancing for borrowers with multi-currency debt. A European company with dollar-denominated bonds faces not only higher U.S. interest rates, but also potential currency losses if the euro weakens against the dollar. The lack of coordinated policy easing suggests central banks are constrained by inflation concerns that prevent the aggressive rate cuts and renewed quantitative easing that would ease refinancing stress but risk stoking inflation. Corporate behavior patterns reveal defensive positioning by companies facing 2026 maturities. Asset sales have accelerated across sectors as companies seek to raise cash for debt repayment rather than refinancing. Announced strategic divestitures, business unit sales, and real estate dispositions have totaled over $400 billion globally during 2025, well above the $280 billion typical in recent years. The acceleration indicates companies prefer to sell assets and use proceeds to pay down maturing debt rather than refinance at double the previous interest rate. Equity issuance has increased substantially, with over $180 billion in seasoned equity offerings during 2025 versus $120 billion in 2023. Companies are diluting existing shareholders by issuing stock to raise cash for debt reduction, accepting the dilution as preferable to the increased interest burden of refinancing. Dividend reductions or suspensions have been announced by over 200 publicly traded companies globally during 2025, an unusually high number during a period when the economy is not in recession. Companies are cutting dividends to preserve cash for debt service. Capital expenditure growth has turned negative, with business investment falling approximately 8% year over year in the third quarter of 2025. Companies are deferring expansion, modernization, and growth projects to hoard cash against refinancing needs. Usage of revolving credit facilities has surged 35% as companies draw on bank lines to build cash reserves as insurance against refinancing difficulties. Each of these corporate actions is individually rational given the refinancing challenge ahead, but collectively, they are economically contractionary. Asset sales create oversupply in those markets, pushing prices lower and creating losses for other holders of similar assets. Equity issuance dilutes earnings per share and typically pressures stock prices lower. Dividend cuts reduce income for investors, many of whom depend on dividend income for living expenses, forcing them to reduce spending. Capital expenditure reductions slow productivity growth and future revenue potential. Credit line drawdowns reduce bank capacity to lend to other borrowers. When thousands of companies across global markets take similar defensive actions simultaneously, the aggregate effect is economic slowdown that makes the initial refinancing concerns self-fulfilling. Foreign exchange reserve management by central banks shows subtle but significant shifts away from dollar accumulation despite dollar strength. Dollar-denominated reserves have declined from 58% of global central bank reserves to 56% through 2025, continuing a multi-year downtrend from the 71% peak in 2000. In absolute terms, foreign central bank dollar holdings have been essentially flat at approximately $6.5 trillion, while global reserve assets have grown, meaning the dollar's share is declining. Euro reserve holdings have remained stable at approximately 20% of total reserves. UN-denominated reserves have continued gradual increases from 2.8% to 3.4% as China promotes greater use of its currency in trade settlement, and some nations seek alternatives to dollar dependence. Most strikingly, central bank gold purchases have surged to over 1,100 metric tons in 2025, the highest annual accumulation since 1967. Central banks are buying physical gold at rates not seen in nearly 60 years, while simultaneously reducing dollar asset accumulation. This pattern suggests diversification motivated by concerns about dollar stability or the sustainability of dollar-denominated debt, even as the dollar remains strong in foreign exchange terms. Interest rate derivatives, markets and credit default swap pricing reveal sophisticated institutional expectations for how the refinancing stress will unfold. Interest rate swap curves are pricing Federal Reserve rate cuts, bringing the policy rate from current 4.5% to approximately 3% by late 2027. This pricing indicates markets expect economic weakness, potentially recession, will force the Fed to cut rates substantially. The cuts are being priced not as preemptive policy easing to facilitate smooth refinancing, but as reactive cuts responding to economic contraction and financial stress. Credit default swap spreads for corporate issuers with significant 2026 maturities trade 60 to 100 basis points wider than CDS spreads for the same issuers on contracts protecting against defaults in later years. This term structure inversion in CDS markets prices elevated near-term default risk specifically associated with the refinancing event. Swaption volatility, the implied volatility of options on interest rate swaps, has risen to elevated levels, indicating uncertainty about the path of interest rates, and expectations of potential sharp moves in either direction, depending on how refinancing stress unfolds. Correlation measures show credit default swap spreads moving together across issuers and sectors more than historically normal, indicating markets are pricing systemic risk that affects all borrowers rather than idiosyncratic risk specific to individual companies. All of these signals, credit spread, widening, yield curve flattening, central bank policy constraints, corporate defensive actions, reserve diversification, and derivatives pricing, converge on a consistent interpretation. Market participants with the sophistication and resources to position ahead of stress recognize that the $9.1 trillion refinancing cannot occur smoothly at current rates and credit conditions. They are pricing elevated default risk, expecting economic weakness that forces central bank easing, and taking defensive actions to protect against losses. The signals are not panic, Markets continue to function, credit continues to flow, economic activity continues, but they represent steady repricing toward recognition that the debt accumulated during the zero-rate era was predicated on conditions that no longer exist, and that the refinancing will not be routine. Historical precedent for concentrated debt maturity, waves meeting inadequate refinancing capacity, provides clear patterns for how such episodes unfold. The mechanisms through which stress cascades from individual borrowers to systemic crisis and the ultimate resolutions that emerge after defaults, interventions, and economic adjustments restore some form of equilibrium. The 1982 Latin American debt crisis began with Mexico's announcement in August that it could not service $80 billion in foreign debt, starting with an $80 million missed interest payment. Within weeks, the crisis spread to Brazil, Argentina, Venezuela, Chile, Peru, and eventually 16 nations across Latin America and beyond. The total debt involved was approximately $300 billion, which was massive by 1982 standards, but represents only 3% of the current $9.1 trillion maturity concentration. The crisis required intervention by the International Monetary Fund, which provided bridge financing to prevent complete default, and by the U.S. Federal Reserve, which encouraged American commercial banks to restructure loans rather than forcing immediate repayment that would have bankrupted borrowers and potentially the banks themselves. Commercial banks were forced to establish loan loss reserves exceeding $20 billion against Latin American exposure. The affected nations experienced a lost decade of economic stagnation, with per capita incomes falling and not recovering to 1980 levels until the early 1990s in many cases. The resolution took over a decade of painful adjustment, debt forgiveness, and structural reforms before growth resumed. The mechanism of cascade was contagion through the banking system. The same major U.S. commercial banks that had lent aggressively to Mexico, Citibank, Bank America, Chase Manhattan, had also lent to Brazil, Argentina, and other Latin American nations. When Mexico defaulted, banks recognized that loans to other similarly situated borrowers were also at risk. They moved to protect capital by reducing exposure across all emerging markets. Nations that might have been able to refinance under normal conditions could not, because their creditors were impaired in pulling back. This created a spiral where initial defaults caused bank retrenchment, which forced more defaults, which caused more retrenchment. The cascade from one country to 16 countries took only 18 months, demonstrating how quickly contagion spreads through interconnected credit markets once confidence breaks. The European sovereign debt crisis during 2010 through 2012 involved approximately $2 trillion in government debt across Greece, Ireland, Portugal, Spain, and Italy, becoming difficult or impossible to refinance at sustainable rates. Yields on Greek government bonds spiked from 5% in early 2010 to over 30% by 2012. Irish and Portuguese yields reached 10 to 14%. Spanish and Italian yields rose to 6 to 7%, levels considered the threshold where debt dynamics become unsustainable given their debt to GDP ratios. The crisis required $750 billion in official sector bailout programs from the European Union and IMF. The European Central Bank intervened through the Securities Markets Program, purchasing distressed sovereign bonds, and eventually through the Outright Monetary Transactions Program, announced by ECB President Mario Draghi, promising to do whatever it takes, including unlimited bond purchases if necessary to preserve the euro. The affected nations were required to implement harsh austerity, dramatic spending cuts and tax increases as conditions for the bailouts. The consequences were devastating for the peripheral European economies. Greece suffered GDP contraction of 25% from 2010 to 2016, comparable to the U.S. Great Depression. Unemployment exceeded 27%. A generation of young people emigrated, seeking opportunities elsewhere. Ireland and Portugal experienced less severe but still substantial contractions. Even a decade later, many of these nations had not recovered to pre-crisis output levels. The resolution prevented defaults through official sector support, but required economic depression as the price of avoiding default. The lesson was that even with massive intervention, avoiding default does not avoid severe economic damage. It only changes the distribution of losses from creditors to citizens through austerity and depression. The 2020 corporate debt crisis was aborted before defaults materialized, but provides insight into how quickly credit markets can freeze when confidence fails. In March 2020, corporate bond markets completely seized up as pandemic. Uncertainty caused investors to refuse new issuance at any price. Approximately $1 trillion in corporate debt was scheduled to mature in 2020 and faced refinancing into markets that had essentially closed. The Federal Reserve intervened within days, announcing not just purchases of treasury bonds, but explicit purchases of corporate bonds, including high-yield debt rated below investment grade. The intervention was unprecedented, Never before had the Fed directly purchased corporate credit at scale. The effect was immediate. Credit markets reopened within weeks, as investors understood that the Fed was providing a backstop. Borrowers that would have defaulted or faced bankruptcy were able to refinance, creating a generation of zombie companies that survive only because of artificially low rates and Fed support rather than genuine economic viability. The moral hazard created by the 2020 intervention contributes directly to the current vulnerability. Companies that should have defaulted during the pandemic were rescued by Fed policy, allowing them to continue borrowing at suppressed rates. Much of the debt maturing in 2026 was issued by these marginal borrowers taking advantage of Fed support. When that support is withdrawn and rates are normalized, these companies face insolvency. The intervention prevented short-term crisis, but deferred the reckoning and potentially made it larger by allowing weak borrowers to accumulate even more debt before the inevitable collapse. For the current $9.1 trillion maturity wave, historical patterns suggest a progression through identifiable stages if even a modest percentage proves unable to refinance smoothly. If 10% of the $9.1 trillion faces serious refinancing stress, approximately $910 billion in distressed or defaulting debt, the consequences would unfold through multiple channels simultaneously. The corporate sector would experience a default wave concentrated in high-yield borrowers, but spreading to lower investment-grade companies that face downgrades, pushing them into high-yield territory where refinancing costs become prohibitive. Default rates in the high-yield sector could spike from current 3.8% toward 8 to 10% seen during the 2008 crisis. On $600 billion in maturing high-yield debt, an 8% default rate implies $48 billion in defaults. Downgrades would affect perhaps 15% of investment-grade issuers, shifting roughly $180 billion from investment-grade to high-yield ratings. These downgraded credits would then face high-yield refinancing costs of 8 to 9%, forcing some into financial distress or default as well. The defaults would trigger layoffs as companies restructure, reduce operations, and liquidate assets. Business investment would collapse as companies facing refinancing uncertainty defer all non-essential spending. Merger and acquisition activity would freeze as financing for deals becomes unavailable and targets are distressed. The government sector would face interest expense surges that force fiscal choices. The additional $180 billion in annual interest expense from refinancing government debt at higher rates represents roughly 4% of combined government revenues across affected developed economies. This may seem modest, but occurs in the context of already large deficits and limited political will for either spending cuts or tax increases. Weaker sovereigns, Italy with 140% debt to GDP, Spain, emerging markets, would face yield spikes as credit markets differentiate between strong and weak credits. These yield spikes could force the weaker sovereigns to either accept harsh austerity to restore confidence or require official sector bailouts from the IMF or European Stability Mechanism. Political instability would follow as austerity programs trigger public backlash, strikes, and potentially government collapse, as occurred in Greece and Italy during the European crisis. The commercial real estate sector would experience a wave of distressed sales and defaults concentrated in office and retail properties. If $80 to $120 billion in maturing commercial real estate loans cannot refinance due to insufficient property values, these properties would face foreclosure or distressed sale. Forced sales establish new pricing comps that mark down values on similar properties across entire markets. Banks holding commercial real estate loans would face impairments requiring loan loss reserves. Regional and community banks with heavy commercial real estate concentration would face capital erosion, potentially threatening some with insolvency. Urban municipalities dependent on property tax revenue would face fiscal crises as commercial property values and tax revenues collapse. The financial system broadly would face capital erosion, liquidity stress, and potential instability. Banks would increase loan loss provisions for expected defaults in corporate and commercial real estate portfolios, reducing reported earnings and capital. Shadow banking entities, private credit funds, collateralized loan obligations, real estate investment trusts would face redemption demands from investors seeking to exit before losses materialize. Redemption pressure forces asset sales to raise cash, pushing prices lower, creating mark-to-market losses for remaining investors, triggering more redemptions. If this dynamic becomes severe, it could require central bank emergency liquidity provision to prevent shadow bank runs from spreading to traditional banks and creating systemic instability reminiscent of 2008. The economic spillover from corporate distress, government austerity, real estate collapse, and financial system stress would be recession. Credit contraction reduces business investment and consumer spending. Corporate distress creates layoffs. Austerity reduces government spending. Falling asset prices destroy wealth. These effects reinforce each other. Unemployment reduces consumer spending, which reduces corporate revenues, which increases defaults, which tightens credit further. The feedback loops are self-reinforcing once initiated. Unemployment could rise from current 4% towards 6 to 8%, well into recessionary territory. GDP contraction of 2 to 3% is plausible if credit conditions tighten severely. Central banks and governments would face intense pressure to intervene with overwhelming force to prevent systemic collapse. The likely response would be Federal Reserve rate cuts from current 4.5% towards zero, resumed quantitative easing focused on both government bonds and corporate credit, and creation of emergency lending facilities targeting stressed sectors. The European Central Bank would likely implement similar measures. Governments would enact fiscal stimulus to offset the contractionary effects of private sector deleveraging, but these interventions would occur in an environment where inflation remains elevated at 3 to 4% rather than the near zero levels that prevailed when similar measures were implemented in 2008 and 2020. Aggressive easing with inflation still above target creates risk of stagflation, high unemployment combined with persistent inflation, the worst of both conditions simultaneously. The geopolitical consequences would extend beyond economics. If the United States requires massive Federal Reserve intervention and trillion-dollar-plus fiscal deficits to prevent default cascade, international confidence in dollar hegemony would be tested. Foreign central banks already reducing dollar reserve accumulation would accelerate diversification. China and other nations seeking alternatives to dollar-based financial system would exploit the crisis to promote yuan or alternative currency use in trade settlement. Capital controls might be imposed by nations seeking to prevent currency crisis during stress. The BRICS nations, Brazil, Russia, India, China, South Africa, have discussed alternative payment systems and reserve currencies. A crisis requiring massive dollar creation to prevent U.S. debt defaults would provide momentum for these efforts. The resolution would likely take years, combining elements of defaults, reducing the debt stock, inflation eroding the real value of debt that is serviced, and gradual economic recovery restoring debt service capacity. The adjustment would be painful regardless of mechanism. Defaults cause losses and unemployment. Inflation destroys purchasing power and savings. Austerity reduces living standards. The ultimate outcome depends on policy choices not yet made, but history provides no examples of debt burdens. This large being worked off without substantial economic pain distributed across creditors, debtors, and citizens. In 1982, an $80 million missed interest payment revealed that $80 billion in debt was unsustainable. The small payment did not matter economically. What mattered was that admitting inability to pay anything destroyed confidence that anything could be paid. Within 18 months, 16 nations defaulted. The total debt was $300 billion, less than 4% of the debt maturing in 2026. $9.1 trillion. Issued during 2020 and 2021 when central banks had pushed interest rates to zero or negative and promised unlimited support. Borrowed by governments at 0.5 to 2%, by corporations at 2 to 4%, by commercial real estate at 3 to 4%. All predicated on assumptions that rates would stay low, central bank support would continue, and refinancing would be routine. Every assumption failed. Inflation returned not to 2%, but to 8 or 9%. Central banks raised rates from 0 to 4 or 5%. Quantitative easing reversed to quantitative tightening. The borrowers who issued debt expecting to refinance at similar or lower rates now face refinancing at double or triple the cost. The additional interest expense of $270 billion annually is permanent, must be funded from revenues that have not grown proportionally, and offers no easy resolution. The signals accumulate across every market. Credit spreads widening globally, yield curves flattening or inverting, central banks unable to coordinate easing, corporations selling assets, cutting dividends, deferring investment, foreign reserves diversifying away from dollars, derivatives pricing elevated default risk, and expected rate cuts responding to economic contraction rather than preventing it. No individual signal proves crisis, but collectively they reveal sophisticated market recognition that smooth refinancing is unlikely. The mathematics allow no ambiguity. Credit markets that absorb $8.5 trillion annually must absorb $11.6 trillion in 2026, the $9.1 trillion in maturity wave, plus $2.5 trillion in new deficit borrowing. The 36% excess over normal capacity must be filled through higher yields attracting more private capital, renewed central bank intervention creating artificial demand, or defaults reducing the amount requiring refinancing. Historical patterns from 1982, 2010, and 2020 show that when debt maturity waves exceed market capacity, the resolution involves some combination of all three mechanisms: rising yields, official intervention, and defaults, with the specific mix depending on policy choices and the speed with which stress cascades. The unprecedented aspect is scale. $9 trillion exceeds the annual economic output of Japan and Germany combined. It exceeds the total assets of the Federal Reserve. It represents borrowing during a brief window when emergency policies created temporary conditions that could not persist. The debt exists. The maturity dates are known. The interest rate differential is observable. The refinancing must occur. Whether it occurs through orderly market processes or through recognition that the debt was never sustainable at market rates will be determined by how much stress credit markets can absorb and how quickly central banks respond when absorption capacity is exceeded. This is not prediction of timing or magnitude. This is observation of scheduled events and historical patterns when debt maturity concentrations meet inadequate refinancing capacity. The pattern has repeated with consistency, approaching inevitability across centuries: 1340s England, 1920s corporate America, 1982 Latin America, 2010 Europe, 2020 global corporations. The mechanism is identical. Debt accumulated during easy credit conditions becomes unserviceable when conditions normalize. The resolution is painful regardless of form: defaults, inflation, depression, or some combination, creating permanent economic scarring. The countdown is to a year, encoded in contracts issued during 2020 and 2021 with 5-year maturities. The obligations are legal and certain. The interest rates required are observable in markets today. The gap between capacity and requirement is arithmetic. What remains is observing whether this time proves different from all prior episodes, or whether the pattern repeats with amplitude proportional to the $9.1 trillion concentration that represents the largest scheduled debt refinancing event in human history.